Let's look at Affirm's stock price chart. 30 days ago, it was $20 per share. Now it is at 4,202% higher. Let's move to the right and look at the analysts' price target. Their average price target is 50% lower than its current price. So who is right? Is Affirm 100% better fundamentally than where it was 30 days ago? Or are the financial analysts right about Affirm's stock and the stock is overvalued? Let's talk about that. I'm Hoda, Mehr, founder and CEO of StockCard, a fintech startup from California that helps you do your fundamental stock market research better and faster. On this show, I share detailed analysis like today's episode on Affirm's stock, or fascinating investing related stories like last week's episode on how Charlie Munger invests. If you are new here, join us by subscribing. Let's break down why Affirm's stock is up more than 100% in 30 days. Looking at this stock price reaction to the latest quarterly earnings report, I highly doubt the jump is purely fundamentally driven. One reason for this is explained by the fact that Affirm is a stock held by Round Hill Meme Stock ETF, meaning it has a significant portion of its outstanding shares shorted, resulting in a positive short squeeze in the last few weeks. But there was positive news from the earnings report that triggered the short squeeze to happen. So what's going on here? Quarter over quarter, revenue was up almost 30%, mainly thanks to a $50 million jump in interest revenue. While the company didn't generate positive net income, the losses got drastically smaller this quarter. Affirm has been able to cut down its marketing, sales, and administration costs, which has helped with smaller losses. Another good news is that Affirm generates free cash flow by subtracting stock-based compensation from its bottom line. The company has over $6 billion in cash and cash equivalents versus $5.5 billion in total liabilities and almost $2 billion in annual revenue. The Affirm card that was recently launched already gained a 3% share of the company's active user base and is up to 500,000 users. It's a card that allows people to pay for purchases immediately from their bank account or over time, effectively replacing both the debit and credit card in customers' wallets. Moreover, Affirm's recently partnered with Amazon to offer a buy now, pay later product to Amazon's business customers, and it already has a remarkable merchant partner list, including high rollers such as Shopify's ShopPay. In terms of moat, the company benefits from a strong technological moat. To understand Affirm's technical superiority in the BNPL space, you must listen to Shopify's executives discussing why they chose Affirm.
Why did you pick Affirm? You had your choices, you know how to build code.
Yeah, we had actually started down this path of building a competitive product ourselves. And as we got deeper and deeper into it, you realized like three things. One, first of all, this is insanely difficult engineering to do this well. Like to do this at scale with performance without losing your shirt is just insanely difficult engineering, which at first, didn't appear to us that way, but it is very, like in order to do this equal, we just have to have as many engineers as the firm has just to build it for ourselves, which is not an investment that we were looking forward to making. Second, underwriting just tends to be large scale problem, and we have more scale than most people. But obviously Affirm is the best company in the world at underwriting consumers. And third, it just became about what do you want to work on any given day in and out? And we wanted to spread commerce for our merchants rather than build consumer lending products. And also, we just launched way faster, way better, and are in a green path of perpetually improving the product without having to always invest in it.
Apparently, Shopify wanted to build its own buy now, pay later product, but realized the technical knowledge of financial underwriting and the risk it has to take are massive and decided to go with Affirm instead. Shopify wanting to avoid dealing with underwriting buy now, pay later loans on its own is a segue to assessing the risks of investing in Affirm. Affirm takes care of the risk assessment of its customers in-house and holds some of the loan balances on its own balance sheet. If anything happens and the customers can't pay off their loans, Affirm's balance sheet and the revenue that comes from reselling these loans to other financial institutions may go down and get impacted. In early December, the US government's Office of Comptroller and Currency issued a bulletin warning banks and financial institutions of the hidden risks in buy now, pay later or BNPL lending. The government warns financial institutions of the credit risk associated with buy now, pay later products. BNPL customers are typically lower income customers who may have exhausted their credit card balances already, since BNPL transactions still need to be included in traditional credit scores. Customers may overextend themselves with several BNPL purchases. Moreover, if a customer uses multiple BNPL products across BNPL companies such as Affirm, Square, and PayPal, no one would know. That means it's hard to judge the risk BNPL companies such as Affirm are facing. As this market grows, these companies may be unable to collect some of the loan balances they issue. Affirm specifically has shared the data that the delinquency rate on its loan is quite steady and much better than its competitors. However, there is still time to see that negative impact if there is a broader consumer delinquency risk due to credit card balances and too much reliance on BNPL in the coming quarters. The other risk is that the growth we've seen on Affirm's top line and bottom line is almost entirely thanks to higher interest revenue and cutting data, marketing, and general and operational and administrative costs. The so-called path to profitability isn't clear yet. If no more cost cutting is possible, we now need to see higher margin products grow for Affirm to become profitable. That's possible with new Affirm card, but it is something to watch in the coming quarters and years. The other risk is the company's stock price valuation. With the recent 100% jump, the valuation is up to more than 4 times price to sales ratio higher than the company's peers, indicating investors are already pricing more than 4 times growth in revenue. Mind you that the current valuation is still drastically lower than the all-time high of 25 times price to sales ratio back in 2021. Assuming Affirm can grow its top-line revenue at the same rate as the overall BNPL market, which is expected to grow 30% in the next few years, then in a little more than 5 years, Affirm can grow its revenue by 4 times or more than that. The question is, can the company keep up with the overall market? And even can the industry grow at this expected 30% rate? No one can predict the future, of course. What would I do with Affirm's stock? If I only want to invest in 20 stocks maximum, which is my goal for 2024, I must make relative judgments about which stock deserves a spot in my portfolio. With that goal, purely from a valuation point of view, I would instead invest in a company like PayPal with a significantly lower valuation at this point of time and a steady free cash flow and positive earnings, which, by the way, happens to have a bigger market share in BNPL segment than Affirm. If I want to take consumer delinquency and credit risk and bet on the future of BNPL market, I prefer PayPal over Affirm. There is a fundamental analysis episode on PayPal that you can watch after this episode. I leave a link to it in the show notes. If you watched this episode until this point, I'm quite confident that you have a curious mind and want to do your own research. So continue your fundamental stock market research on Affirm on StockCard, stockcard.io/AFRM. If you end up there and want unlimited access to the StockCard platform, use promo code WELCOME to get 20% off your annual VIP subscription. Let me know what you decide to do with Affirm in the comments, and I'll see you next time.